Welcome back to It's Your Smarter Money with Dr. Laura and Professor Steve, brought to you by Atlas Fiduciary Financial. Today we want to talk to you about the fine line investors walk between the struggling economy, progress with the pandemic, and the uncertainties associated with signs of social and political unrest. We believe this climate continues to require caution. And so we'd like to just talk a little bit about the current economy and what we're looking at going forward. So the U.S. Conference Board publishes a leading index. It's a good indicator of what's going to happen in the economy. And if you're going to look at one indicator, this would give you a quick snapshot. Since it's a composite, however, it won't give you a full picture. It's the index measures 10 leading indicators. But you can see by looking at this quick snapshot that it looks like the economy is holding its own. It's pretty much above water and it's doing well compared, of course, to where it was in 2008, 2009. Steve's going to talk a little bit about the some of the detailed economic indicators.
Yeah, and see, a couple of these we're talking about are really key indicators. Unemployment and also GDP growth. And unemployment actually peaked somewhat over 14% in the spring, I think around April, I think. Although that was much less than what had been predicted. Some people predicted probably it might hit 20% or more, which would have been higher than the levels during the Great Depression. By the way, the increase in unemployment was unprecedented. I think it's the highest increase in such a short period of time, almost in history. And also, second quarter GDP was minus 32%, which was an amazing decline. And that was actually 8% for the quarter, but it's annualized at 32. But now we seem to have started to experience that V-shaped recovery that a lot of people thought we might experience, because the economy was fundamentally strong. It was really the shutdowns and the uncertainty with respect to COVID-19 that really led to this damage that occurred. And I just want to mention before I say that we actually are doing better than a lot of the G5 economies, Europe and some of the other countries. So now unemployment has dropped back down to somewhat over 8%, maybe 8.3 or 8.4. And the Federal Reserve predicts that it could be around 6.5 to 8% by year end. And by the end of 2021, back down to about 5.5%. And the Atlanta Federal Reserve Bank estimates now, as of October 6th, that GDP growth for the third quarter could be almost 36%, which works out to actually about 9% for the quarter, or 36% annualized. So we are experiencing a strong recovery at this point, and hopefully it continues.
And again, it's fueled a lot by consumer spending. And even government spending, as you said, but consumer spending is 70% of GDP. So that's really driving a lot of it.
People are actually getting back out there and spending money again. And a lot of the spending was really just deferred. It wasn't ever really just eliminated. Although, of course, things like eating at restaurants, that'll never come back because people just are not going to obviously make up for that probably. And so here we're going to talk about some of the asset classes that you have in your portfolio, and the good, the bad, and the ugly. And the astoundingly good, frankly, are convertible bonds, up 29% for the year, something I don't think anyone could have predicted. We've been using that asset class for at least 25 years. I've always believed in convertible bonds, although once again, I can't tell you we predicted this. Large cap is up about 5.5%. Muni bonds have done well because interest rates declined. Reinsurance bonds, which are a very unique asset class, are up about 6% for the year, which is phenomenal considering the low interest rate environment which we're in. And international bonds have done well, and alternative investments, which include the hedge fund strategies. Now, on the bad side, of course, are the mid-cap and small-cap value areas. Real estate is still down, international large and international small. We are seeing recoveries in these asset classes. They just have not recovered yet. And I want to make one point, by the way. In the large cap area, you see it's up about 5.5%. That's really sort of weighted toward 5 or 6 stocks that are about 20% of the S&P right now. Probably about half the stocks in the S&P are actually either at break even or negative for the year, believe it or not.
And as we are talking about these different asset classes, we want to make sure that you do understand what they are. And so we're going to be following up with a couple of additional talks. So you might be sitting here saying, well, what really is a convertible bond, or what is a reinsurance bond? We're going to talk about that. A lot of questions that we've been getting recently have been around REITs. Do I have a lot of commercial office space in my REITs? And I do want to tell you that you don't. We've actually been looking at the REITs, and they contain a lot of other kinds of real estate that actually doing well. But we're going to have some more videos on the actual details of that. But one of the things that we wanted to show, this is one of, I think, my favorite slides, if you will. They've been doing this analysis. Callan has been creating this information for about 50 or so odd years. And what they do is they take the asset class, which are all color coded, and they line them up from the top best performing asset class to the least performing asset class in any given year. And so each asset class, for example, the navy blue is large cap, the light blue is small cap, the turquoise is REITs. Let's just look at those, for example. You can see that in the start of this, back in 2001, REITs were the top performing asset class, and going forward. In fact, REITs were the top performing asset class 4 of the years out of these 20 years. Large cap stocks were only the top performing asset class 2 of the year, very recently, 2019 as well as 2015. And honestly, if we were doing this, we had all the numbers in for 2020 year to date, we would say that large cap still would not be on the top because there's convertible bonds and other things. So, we want to make sure that we have exposure to all these different asset classes. One of the things when we look at this chart, it's a keen reminder that these asset classes are always jockeying for top performance status, and that we never want to run after the one that's the top performing status, because oftentimes you'll also notice that the top performer in one year might be the worst performer in another. So there are people that will call us right now and they think, oh, I want to invest in Apple, Amazon, Facebook, Microsoft, and Google, the top 5 stocks, because they've been driving the stock market. And we would think maybe at this point in time, because it's been such the top driver, it's almost a momentum play at this point, that we would caution any major shifts to moving all the way into that.
It never makes sense to try to chase performance. And I think that's why this chart's so great, because it shows you how hard it is to chase performance. You said that well, Laura. The leader one year is the worst asset class the next year, potentially, or in the middle of the pack. It's no longer the leader. So. And
there's been a bunch of empirical studies that have talked about chasing returns, and they've shown over and over again that it never works. Even the smartest people just are not able to do it.
It's a human behavioral characteristic, and I think that's also a great topic for another video. Some of the behavioral faults that we all have as humans that affect the way we invest money.
So what should investors do, Steve?
Yeah, and so if you have cash now, by the way, I would put it in the market very cautiously in any of the asset classes right now. I would probably dollar cost average it in. But if the money's already invested, I obviously would not try to time anything. I would not sell anything. I would just hold fast. We don't know because we've been hearing some people claim that large cap's overvalued. Yeah, but maybe it is, but there could be a lot of other asset classes we have here that are not overvalued, and it's really hard to tell year by year which are overvalued and which are not. Some of that, by the way, that effect of something being overvalued, we automatically take that into account by rebalancing periodically. So we tend to sell the winners gradually and buy the losers, which is, it's a buy, high and sell low. Sell high and buy low strategy, which is really the right thing to do. But we do it through a formula, not through some method of market timing. And also with the bonds, we know interest rates are really, really low. So what we're doing is we're putting together combinations of bonds to try to maximize return on the bonds using different call features, and whether the bond's a premium bond, which means it's selling for above par versus below. And there's a lot of reasons for buying premium bonds in this environment. And also we're carefully managing the maturities to try to achieve the best trade-off between really low rates versus getting more interest by going a little longer, but not excessively long. So we're really trying to monitor that carefully and putting together a solid strategy with the bonds. And we do an analysis using some third-party software from one of our bond houses. They provide us with an analysis that helps us maximize return on the bond portfolio.
Yeah, interest rates are generally a little bit, something that we try to spend a lot of time understanding. The Federal Reserve has recently announced a shift in their inflation policy, and they are likely to keep interest rates on the lower side, but there are other factors that are pushing it higher. And so we're trying to monitor that as well, and that will affect the overall bond strategy. Okay, so that's really all we want to cover. We're going to try to keep this a little bit shorter and sweeter so that you don't have to invest too much time when you listen to one of our videos. But we want to thank you for joining us. It's Your Smarter Money, and we're honored to provide you with the guidance through it. So thank you, and looking forward to seeing you soon.